What's going on, everyone? In this week's housing market update, we're looking at some leading indicators of a shift in buyer and seller sentiment and what it can mean for you as a buyer and seller, as well as what Powell's latest speech at the NABE annual meeting means for the future of the economy and how that could translate to the housing market. Plus, it appears that our local data isn't the only place this shift is starting to show up, so we'll be looking at a few national stories that suggest this may be the start of a national shift in the sentiment and future of housing. So let's get started. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and on this channel, I bring you the latest information in the economy so you can make better decisions when it comes to buying, selling, and investing in Southwest Florida real estate. So please, if you haven't already done so, subscribe to the channel and hit that bell so you don't miss out on the data, tips, and analysis keeping you ahead of the market trends. And before I get into today's market update, I wanted to give a shout out and congratulations to my clients Brian and Julie, who just got their property under contract with me for a record price in their community, and who, like many of you watching, found out about me through this YouTube channel. I'm so glad I could be a part of your journey. All right, so I've got some long-awaited news for you buyers that have been holding off in this market and some potentially worrisome data for sellers in this week's update. So let's start with the week-over-week local market data. All right, so let's take a look at our 7-day market update. These are actually the stats from last week. I know I missed last week's market update, but these stats are week-over-week, as I had mentioned before. So I will be covering both weeks. So last week we had 859 new listings. That was actually up I believe 50 or so listings, 58 listings, I believe, from the week before. So last week we saw another increase up into 859. Now this week we're back down to 788, but still 788 is still above what we've been seeing for trends over the last year and a half. We've been staying somewhere usually in the low 700s to actually below 700 for new listings coming on week over week. So that is still up, but it is down from last week. That's down 9% from last week. Solds went from $999 last week, which was also up a little bit from the week before. Now it's back down to $947, so that is good news. The listings and the solds have both decreased. And then we have the pendings that actually stayed and have been staying consistent for the last 3 weeks now. Not too much of change in the pending sales, so that's good news for that. As far as total inventory breakdown goes, single families, we went from 2063 last week, so this is last week, to this week, which was up to 2097. So that's a gain of 34 additional single-family homes that came on the market and are still on the market active. And then condos, we went from last week 1010 to this week 1025, which is a gain of 15. And then below, just because I'm covering 2 weeks, I put what it was. So last week we had a net gain of 156 new additional homes combined for single families and condos on the market. And now again this week we're up another almost 49 net gain. So over the last 2 weeks, we've actually gained over 200 new listings on the market and still active. So that is, again, a rise that we've seen over the last 3 weeks. I think, 2 weeks it could be, just a kind of something out of the blue, but I think 3 weeks in a row, we're starting to see that trend now shift. And you're also seeing that in the stock market where the REITs are starting to shift and go the other way. They're starting to lose some ground. Multifamilies, last week we had 78. This week we're up to 88, so it's a gain of 10, and that is up 13%. Whereas the foreclosures, we actually went down a couple. Last week we were at 35. This week we're at 32, which is a loss of 3 or 9% down. Interest rates. This has been the big story and the big kind of the big scare in the market right now is the interest rates. Last week we were up to 4.3. That was up quite a bit. This week we're now up to 4.8 according to Nerd Wallet. And then bank rate has us going from 4.55% last week to 4.56% this week. That's only a gain of 1 percentage point. The big story here though is some of the, it depends on what source you're looking at for data, but some of them are ranging anywhere from 4.5% up to almost 5% now. I think one of the latest ones I saw was 4.97%, which is right on the cusp of the 5%. And that's before the Fed does any other additional rate hikes, which they are planning to do over the next 5 or 6 meetings that they have left. All right, let's get right into the trends in real estate. So first one is from 2 weeks ago. The Fed hiked 25 basis points. So that's the first interest rate hike in more than 3 years. And they also said that they do see 6 more ahead. So that this first one was just a 0.25 percentage point rate hike. That's the first since December 2018. They also indicated that there was an aggressive path ahead with rates increasing coming at each of the remaining 6 meetings in 2022. And then we're going to take a listen to what Powell had to say at the NABE meeting, the National Association of Business for Economics. What he said there, which is his latest speech to come out after the meeting, and I think you're going to be surprised by that. They also did raise their outlook for inflation. So just a little bit of quick math here at the bottom. Rates increase 0.5% in addition to where we're at already, plus another 0.25% at the next 5 after that. We're looking at a 1.75% increase in the Fed rate. So that's up to 2.25% by 2023. So let's take a listen to what Jerome Powell had to say at his latest meeting. And I think we're going to get a pretty good idea of where the Fed is headed in their next meeting in May.
At the Federal Reserve, our monetary policy is guided by the dual mandate to promote maximum employment and stable prices. From that standpoint, the current picture is plain to see. The labor market is very strong and inflation is much too high. My colleagues and I are acutely aware that inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials, like food, housing, and transportation. There is an obvious need to move expeditiously to return the stance of monetary policy to a more neutral level, and then to move to more restrictive levels, if that is what is required to restore price stability. We are committed to restoring price stability while preserving a strong labor market. At our meeting that concluded last week, we took several steps in pursuit of these goals. We raised our policy interest rate for the first time since the start of the pandemic and said that we anticipate that ongoing rate increases will be appropriate to reach our objectives. We also said that we expect to begin reducing the size of our balance sheet at a coming meeting. In the press conference after the meeting, I noted that action could come as soon as our next meeting in May, though that is not a decision that we've made. We will take the necessary steps to ensure a return to price stability. In particular, if we conclude that it is appropriate to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings, we will do so. And if we determine that we need to tighten beyond common measures of neutral and into a more restrictive stance, we'll do that as well.
So I think that pretty much sums it up. We're going to see that we're probably going to see another 50 basis points in the next meeting in May, which is another month away still. But when we do see that, I would guess that we're also going to see mortgage rates go over 5%. We also do have CPI and PPI data coming out in the next couple of weeks, which will indicate how hawkish the Fed will be on raising those rates in their consecutive meetings after May. All right, next story is National Association of Realtors. So they did report that February existing home sales dropped 7.2%. Year-to-year sales declined 2.4%. So it's a double whammy right now. Mortgage rates and sustained price increases have been putting a damper on the buyers in the market. Monthly payments have risen by 28% from 1 year ago, which is not part of the consumer price index, as we have spoken about in I have spoken about in previous market updates. Total housing inventory at the end of February totaled 870,000 units. That's up 2.4% from January and down 15.5% from 1 year ago. Unsold inventory sits at a 1.7 month supply at the current sales pace. That's up from the record low supply in January of 1.6, but also down from 2 months in February 2021. So I think the drops here are really partially due to the low inventory. Obviously, there's less inventory, so buyers have left choices. Some of them are just sticking to their guns. They want a specific property and an affordable rate. They're just not seeing that, so they're backing off and holding off until things change a bit. So inventory, and then also you have the buyer sentiment, and then the interest rates rising. That's all contributing to the dip here. February, new housing starts also surpassed expectations. So a disappointing dip in January new home starts was followed by a surprise surge in February. So economists expected 3.2% growth, but starts rose by 6.8%. So that's over a 200% increase there. And then they surged to 6.8% last month. In addition, the building permits, a sign of the future activity. So that's a lagging indicator. Month to month we're down slightly month to month 1.9%, but they were 7.7% higher year to year. So the starts are way up compared to what was predicted or what was forecasted. The permits are down, and we also have confidence is down. So I think this is starting to show us, the market is starting to shift. Looks like we're heading the other way now. Again, this is something that we're going to have to keep an eye on because, like a bear market, we will see, bounces. So next 1 month, it might be up a little bit, then it will drop down even further. Then it might be up again and drop down further. So we'll have to keep our eye on that. Also, builders' confidence is another indicator that's dipped 4 months in a row now. It's still pretty high, but it has dipped. So home builders' attitudes fell below 80 for the first time since last September. That's on a scale of 0 to 100. So obviously, the higher the number, the more confident the builders are. That is now actually starting to dip below the 80 mark, whereas lowest future sales expectations in surveys since June 2020. Growing concerns that increasing construction costs, which have been up 20% over the last 12 months, and expected higher interest rates. Again, as you'll see throughout this market update, the theme here that concerning most people is the higher interest rates. And that they're expecting that tightening monetary policy will price prospective home buyers out of the market. So again, confidence is down and appreciation is starting to slow. Our last story here is something that has been happening. We've seen this actually going back to October, where we had our first yield curve inversion, but not one that many people look at. It was just an indicator of potentially what was coming. Now, over the last 2 to 3 weeks, we have seen several other yield curves invert. The reason this is important, the yield on the 5-year and Treasury note rose above the yield on the 30-year Treasury note bond, an event that hasn't happened in the last 16 years. So the last time this did happen was right around 2000, in the 2000s, 2006. Most closely watched relationship is a gap between the 2-year and the 10-year Treasury. So an inversion of those two yields has heralded the past 10 out of 13 recessions, according to Bank of America. So the interesting thing about the 10 out of 13 is that not every time we've had a recession did the yield curve invert. However, every time the yield curve inverted, we did have a recession. So essentially the 2 and 10 year, every time that has inverted, we have 100% of the time we have had a recession. And you can back test that through the charts, but that has always been the case. And that's why it's been a huge indicator and why people are watching that. The other one to look out for is the 5 and the 30. When that gap closes, it is usually indicating future corporations are not seeing a favorable market in the future. So that means if they're not spending more, they're not seeing favorable conditions, then usually that's an indication that the economy is starting to slow or will be slowing in the future. Now, again, when the curve inverts, it's not like that means we're in a recession right now, although I think we are starting to see signs of that. It usually is a lagging indicator. So within months of that, usually within the next 6 months of the yield curve inverting, that's when you start to enter into a recession. So every time the 210 inverts, we have had a recession, and I think this is something we're going to need to watch out for. It hasn't inverted yet, but several others have. So this would be one of the next ones to invert. So I think that's something that we need to keep an eye on. And we'll add that to the wall of worry, as you can see here. But we do need to keep an eye on the future Fed hikes. So are they going to raise 50 basis points in the next May meeting? And are they going to continue to remain hawkish and another 25 basis points each consecutive meeting after that? that's going to put make affordability an issue. Foreclosures and home sales inventory, it's kind of in our area, our local market, it's been really staying relatively consistent, right in the 20s or 30s. So we haven't seen any huge jumps in that yet, but again, it takes a while for those to come on the market and go through all the legalities. So we will keep an eye on that as well. Inverted yield curve, as we just said, that could be an indication of a recession coming, and could be an indication of future job losses around the corner. The bear market and recession, I think we're in a bear market still, even though we've had some pretty good gains over the last week and a half. But that's expected in a bear market. You have gains, and then all of a sudden you have these huge losses too. And then finally, China shutdowns, that's becoming an issue. Oil is down right now because of that. We're also expecting even more issues with the supply chain because of that as well. And then we also have the conflict in Ukraine still going on, which we still have no idea what's going to happen with that, which is a huge wild card in the economy right now. So these are all things that we're going to keep an eye on. But again, this is the market update. These are the stats that I'm looking at, and this is just what I think. Please let me know what you think in the comments below. I'd love to hear your take on the economy and where you think we're headed. Thanks for watching, and if you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to register on my site to get access to loads of exclusive tools, data, and content like foreclosure and open house lists, buyer and seller guides, calculators, and access to our Southwest Florida MLS. If you have any questions, please don't hesitate to give me a call or send me a text at 239-310-5478. And if you prefer email, you can send one to rick@swflrelocationteam.com. Thanks again for watching to the end, and I hope to see you next week.